Hello, welcome to my quick video on using loan amortization schedules. I'm Alex Coy, and let's just get right into it. A lot of people don't really understand what they get themselves into with a loan, but I'm going to touch base on a couple of basic principles. First off, I'm using Microsoft Excel on an old product version apparently, but this can also be done in Google Sheets. I'm very comfortable with Microsoft Excel, so I will just get into it. If I go to File, I can open up a new document. I'm going to search for a template and just abbreviate loan amortization calculator with extra payments, or a regular loan amortization schedule. So now, let's take a quick look at what we've got. Loan amount, let's use a $250,000 purchase price. Interest rate, let's just say 4. Loan period, we'll go with 30. Start date of the loan, let's say January of 2020. So now we have all of this information populated. Our scheduled payment is $1,193. This is not including property tax, insurance, mortgage insurance. This is just your interest and payment. There's an acronym for mortgage payments called PITI, Principal, Interest, Tax, Insurance. You may also add HOA fees to that and possibly mortgage insurance. So here we see paying about $1,200 a month. Only $360 is going to principal and $833 going to the interest. But every month as we go down, we have the same payment, but our principal keeps adding up and adding up. Right? So now on this January of 2020 loan, let me go down, let's go down 5 years and see where we get to. Here, January, we've paid down $25,000 of our loan so far, and our principal is starting to increase. I'm going to go about 10 years in. 10 years in, we're still paying more principal than we are interest. Right around 12 years is when our interest starts becoming more than our principal. And then this is a 30-year loan amortization, taking us through 2050. So now, a lot of people, let's say you've owned the house 4 years. Let's go into 2024. So a lot of people say, oh, the interest rates fell. Let me refinance. Well, you need to determine what the motivating factor of that refinance is. And I have a few factors. Why should I refinance? How do I know if it's a good idea? There's a few different things to look at. Pulling out cash, lowering the overall interest rate, lowering monthly payments, getting rid of mortgage insurance. So we'll talk about each one of those individually. So if we wanted to refinance, we have to consider everything in the refinance. There's closing costs. There's the loan origination fees. You're probably looking at about maybe 2% of the purchase price in total fees by the time you pay the lender, title insurance, back stamps on the loan, satisfaction of the previous loan. So at this point, 4 years in, your original loan amount was $250,000. You've only paid off $20,000. You're going to be reset in your amortization schedule all the way to the top. So your overall loan amount is going to decrease to $230,000, but you're going to be paying the most amount of interest. So now my payment decreased by about $100 a month, but I'm at the beginning of my loan amortization schedule, when before I was starting to pay off more principal. Now, if we also have an interest rate decrease, that could be a big motivating factor. Sometimes once you get to that $230,000, once you get a little bit lower than that, and you're at a 80-20 loan to value, you would be able to drop your mortgage insurance. However, we're not taking any consideration into mortgage insurance at this payment with my payment simulator. And obviously, a lot of times there's an opportunity to pull out a little bit of cash. On a $230,000 loan amount from a $250,000 loan amount, there wouldn't be any cash to really pull out, but that's just one of the motivating factors. Now, I wanted to show another concept. Let me go change this back to, I'm going to look at something else. If I took this loan from a 30-year loan to a 15-year loan, my payment increased. It increased by about $600. Yeah, just about $600. But if we look over here, that $600 was principal, right? $331 here. I'll undo. $934. So we're only paying more principal. Interest is the same. So the more uncomfortable payment helps you pay down your loan a lot faster. I'm going to tab over the page. I'm going to move actually to Google Sheets to look at a couple of other simulations. I found this loan amortization schedule that shows a few different scenarios. Loan amortization schedule, scenario 1. What if I pay X amount toward the principal every month or once a year? How much sooner would I pay it off? So year of 2010, I'll do a $250,000 purchase price, 4% interest. So in 2010, our total mortgage payments, this amount, principal paid, only $4,500, interest paid, $10,000. This simulation shows it by years and not by months, but that's okay. Now the lifetime of the loan, on $250,000 over 30 years, you end up paying $433,000, of which $250,000 is your principal, $183,000 in interest. Now we move over to this model. If we paid an extra $100, every year, I'm actually going to come back to this in Excel. We had an optional extra payments line here. And I'll make this 100. And I'll populate this extra payment field. Now in a mortgage starting January 1st, 2010, Let's see how much damage that $100 will do. Now we're at $20.35. So $100 a month. Finish the loan 5 years sooner. That's crazy when you think about it that way. Just $100 to get out of debt 5 years faster. That's just a simple way of helping to get out of your mortgage debt sooner. Taking extra money you have, putting it against your payments, your mortgage, can help chunk down that loan payment. A basic principle of finance is to pay whatever highest interest payment you have. If it's a credit card, if it's your car, that's what you should focus on paying down first. Another strategy that a lot of people use, that I use personally, is, let's just say your payment is $1,100. If you add the extra payment, it's $1,200. So if you pay $600 every 2 weeks, so you're paying ahead of your payments, you end up chunking more towards the principal pot, and you end up paying less interest. On a 5-year car loan, that's a strategy I employed. I ended up paying the car loan off about nine months sooner and saved almost $1,000 in interest. To demonstrate a couple more strategies, let's say we have a $250,000 loan, 30-year. So, what happens if this is a $260,000 house, or they're offering $250,000 on a $260,000 house? So let's increase the price, $260,000. The net effect on our payment was just about $50, from $1,241 to $1,193. $45, $48. So that's the difference $10,000 makes. A little less than $50 a month in a payment. Let's also consider if we're at $250 and they give us a counter offer of $252. $2,000 was a difference of $10 in a payment. So when you understand at a 4% interest rate, a couple $1,000, you can really explain counteroffers in a whole different light. You say, oh, well, $252, well, that's $2,000 more than I wanted to pay. Well, are you okay with paying $10 more a month? Yes. Well, then we have a deal. Sometimes explaining things in a different way, truly helps. Now let me run this annual interest rate. Let's say we go up to 4.5. Our payment went up about $70 on that interest rate. So now they're paying almost $1,000 in interest. They should focus on trying to get more principal paid sooner, quicker, and get them out of debt. Quick disclaimer, as this is not financial advice, this is trying to educate on how this works. What makes the most sense for each person is different. I just think, in my opinion, I went to school for my finance degree, trying to get rid of interest payments as much as possible, pay down principal, and get out of debt. The concepts we're talking about today. Don't make too much payment, too much extra payment if it hurts you financially. This is just meant to educate on a few different aspects about the financial loan amortization schedules.